Hello everyone, I'm Desiree Yvette Kabulay and I'll discuss two taxation topics which are Value-Added Tax Reform Act or RA 9337 and the Train Law which is RA 10963. So to start with, I'll talk about the Value-Added Tax Reform Act or RA 9337. So this act was approved on May 24, 2005 by President Gloria Macapagal Arroyo. So what is a value-added tax? It is a form of sales tax. It is a tax on consumption levied on the sale, barter, exchange, or release of goods or properties and services in the Philippines and on importation of goods into the Philippines. And it is an indirect tax which may be shifted or passed on to the buyer, transferee, or lessee of goods, properties, or services. So who are the persons required to register for VAT? Any person who in the course of trade or business sells, barters, or exchanges goods or properties or engages in the sale or exchange of services shall be liable to register for value-added tax if his gross sales or receipts for the past 12 months, other than those that are exempt, have exceeded 1,500,000 pesos. And effective January 2012, it has increased to 1,919,500, and under the Train Law, the threshold is now 3 million. And the second is that there are reasonable grounds to believe that his gross sales or receipts for the next 12 months, other than those that are exempt, will exceed 1,500,000. And just the same, effective January 2012, it has increased to 1,919,500, and under the Train Law, it is now 3 million pesos. So what is the tax rate? So 12% starting February 1, 2006, and the old rate was 10%. And what is the basis for the computation of value-added tax? So for the sale of goods, it is the gross selling price. For the services, it is gross receipts. And for the imports, it is dutiable value plus customs duties, excise tax, and other charges prior to release from customs. So the 12% VAT covers the sale of goods or properties. Second is the importation of goods, and the third is the sale of services and use or release of properties. So for the sale of goods or properties, there shall be levied, assessed, and collected on every sale, barter, or exchange of goods or properties a value-added tax equivalent to 12% of the gross selling price or gross value in money of the goods or properties sold, bartered, or exchanged, such tax to be paid by the seller or transferor. So what is the meaning of gross selling price? It is a total amount of money or its equivalent which the purchaser pays or is obligated to pay to the seller in consideration of the sale, barter, or exchange of the goods or properties, excluding the value-added tax, and the excise tax, if any, on such goods or properties shall form part of the gross selling price. So what deductions can be made on the gross selling price? So the sales returns, allowances, and sales discounts. So the value of goods or properties sold and subsequently returned, or for which allowances were granted by a VAT-registered person, may be deducted from the gross sales or receipts for the quarter in which a refund is made or a credit memorandum or refund is issued. So this is a deduction on the gross sales or receipts. and the sales discount granted and indicated in the invoice at the time of sale. So at the time of sale, and the grant of which does not depend upon the happening of a future event, may be excluded from the gross sales within the same quarter if it was given, and the excise tax, if any, on such goods or properties shall form part on the gross selling price. So the sale of goods or properties include real properties held primarily for sale to customers or held for lease in the ordinary course of trade or business, and it also includes the right or the privilege to use, patent, copyright, design or model, planned secret formula or process, goodwill, trademark, trade brand, or other like property or right. And it also includes the right or the privilege to use in the Philippines of any industrial, commercial, or scientific equipment. And it also includes the right or the privilege to use motion picture films, tapes, and discs. It also includes radio, television, satellite transmission, and cable television time. So we have previously discussed that there is a value-added tax on sale of goods or properties, and it also includes transactions deemed sale. So what are these? So it includes transfer, use, or consumption not in the ordinary course of business of goods or properties originally intended for sale or for use in the course of business. The second is a distribution or transfer to the shareholders or investors as share in the profits of the VAT registered person. So this includes distribution transfer to the shareholders or investors, so a share in the profits of the VAT registered person. And it also includes creditors in the payment of debt. So just in case that the debt is paid through this, so it is a deemed sale. And consignment if actual sale was not made within 60 days. And retirement or cessation of business, so it involves inventories of taxable goods. So the second VATable type of goods is the importation of goods. So there shall be levied, assessed, and collected on every importation of goods a value-added tax equivalent to 12% based on the total value used by the Bureau of Customs in determining tariff and customs duties, plus customs duties, excise taxes, if any, and other charges, and such tax will be paid by the importer prior to the release of such goods from custom duties. And where the customs duties are determined on the basis of the quantity or volume of the goods, the value-added tax shall be based on the landed cost plus excise taxes, if any. And in case of tax-free importation of goods into the Philippines by persons, entities, or agencies exempt from the tax, where such goods are subsequently sold, transferred, or exchanged in the Philippines to non-exempt persons or entities, so the purchasers, transferees, or recipients shall be considered the importers thereof, who shall be liable for any internal revenue tax on such importation. And the tax due on such importation shall constitute lien on the goods superior to all charges or liens on the goods, irrespective of the possessor thereof. So the third vatable transaction is the sale of services and use or release of properties. So there shall be levied, assessed, and collected a value-added tax equivalent to 12% of gross receipts derived from the sale or exchange of services, including the use or release of properties. And in here, the gross receipts means the total amount of money or its equivalent representing the contract price, compensation, service fee, rental, or royalty, including the amount charged for materials supplied with the services, and deposits and advance payments actually or constructively received during the taxable quarter for the services performed or to be performed for another person, excluding the value-added tax. And the sale or exchange of services means the performance of all kinds of services in the Philippines for others for a fee, remuneration, or consideration. So it basically says that the sale of properties or the lease of properties are vatable if they will hit the threshold. So what are the examples of sale of services and use or release of properties? So it includes construction and service contractors, and it also includes stock, real estate, commercial, customs, and immigrant brokers, and it also includes persons engaged in warehousing services. So now we are done with the three transactions which are vatable with a 12% VAT. So for VAT registered person, so there may be transactions which are zero rated or which are not vatable by 12%. So this includes sale of goods and sale of services. So let's start with this zero-rated sale of goods. So it includes export sales. So zero-rated transactions include export sales. So under export sales, there are sale and actual shipment of goods from the Philippines to a foreign country. So export sale also means sale of raw or packaging materials to a non-resident buyer for delivery to a resident local export-oriented enterprise. So the third is the sale of raw materials or packaging materials to export-oriented enterprise whose export sales exceed 70% of total annual production. Export sales also include sale of gold to the Bangko Sentral ng Pilipinas, and those considered export sales under EO number 226 and other special laws. And the last is the sale of goods, supplies, equipment, and fuel to persons engaged in international shipping or international air transport operations. So the next zero-rated sale is the foreign currency denominated sales. So these are sale to a non-resident of goods assembled or manufactured in the Philippines for delivery to a resident in the Philippines, paid for in acceptable foreign currency and accounted for in accordance with the rules and regulations of the Bangko Sentral ng Pilipinas. So a very important feature in this type of transaction is that it is foreign currency denominated, so it is paid in acceptable foreign currency. And so the last zero-rated transaction under the sale of goods are those exempt under special laws or international agreements to which the Philippines is a signatory. And there are also zero-rated sale of services. So this includes zero-rated transactions include processing, manufacturing, or repacking goods for other persons doing business outside the Philippines, which goods are subsequently exported, where the services are paid for in acceptable foreign currency and accounted for in accordance with the rules and regulations of the Bangko Sentral ng Pilipinas. also includes services other than those rendered to a person engaged in business conducted outside the Philippines or to a non-resident person not engaged in business who is outside the Philippines when the services are performed, the consideration for which is paid for in acceptable foreign currency and accounted for in accordance with the rules and regulations of the Bangko Sentral ng Pilipinas. So just like in the first example, sale of service, it is also paid in acceptable foreign currency. And zero-rated transaction also includes services rendered to persons or entities whose exemption under special laws or international agreements to which the Philippines is a signatory effectively subjects the supply of such services to 0% rate. So if a sale is done through, or if the sale of services is rendered to persons who are exempt under special laws, so the percentage of that sale would be 0% VAT. So the following are also zero-rated transactions. So services rendered to persons engaged in international shipping or international air transport operations, including leases of property for use thereof. And for services performed by subcontractors and or contractors in processing, converting, or manufacturing goods for an export whose export sales exceed 70% of total annual production. Zero-rated transactions also include transport of passengers and cargo by air or sea vessels from the Philippines to a foreign country, and a sale of power or fuel generated through renewable sources of energy, such as, but not limited to biomass, solar, wind, hydropower, geothermal, ocean energy, and other emerging energy sources using technologies such as fuel cells and hydrogen fuels. And so that is all about the zero-rated transactions. So we have already discussed about those VATable by 12%, those which has 0% VAT, and so we will also discuss about transactions which are exempt from VAT. So there are various transactions and services which are exempt from VAT. So these include the sale or importation of agricultural and marine food products in their original state, livestock and poultry of a kind, generally used as or yielding or producing foods for human consumption, and breeding stock and genetic materials thereof. So exempt transactions also include fertilizers, seeds, seedlings, and fingerlings, fish, prawn, livestock, and poultry feeds. Also, it includes, so we have discussed earlier is that imported goods are actually subject to VAT, but these are imported goods which are exempt. So those that are for personal and household effects only, belonging to the residents of the Philippines, returning from abroad, and non-resident citizens coming to resettle in the Philippines, and provided that these goods are exempt from customs duties. And also personal instruments and implements, wearing apparel, domestic animals, and personal household effects, so belonging to persons coming to settle in the Philippines. And so basically these are for own use only and not for sale. And also includes fuel, goods, and supplies by persons engaged in international shipping or air transport operations. So exempt transactions and services. So for services rendered by persons subject to percentage tax, agricultural contract growers and milling, for others, papaya into rice, corn into grits, and sugarcane into raw sugar. Also medical, dental, hospital, and veterinary services, so except those rendered by professionals. And so also educational services rendered by private institutions, however, they should be duly accredited by DepEd, CHED, and TESDA. And also individuals pursuant to an employer-employee relationship, so those are transactions exempt from VAT. Also regional or area headquarters established in the Philippines by multinational corporations, which act as supervisory, communications, and coordinating centers for their affiliates, subsidiaries, or branches in the Asia-Pacific region and do not earn or derive income from the Philippines. So, a criteria is that they do not earn or derive income from the Philippines. And also banks, non-bank financial intermediaries performing quasi-banking functions and other non-bank financial intermediaries. So exempt transactions also include sales by agricultural cooperatives duly registered with CDA, and non-agricultural, non-electric, and non-credit cooperatives duly registered with the CDA, provided that the share capital contribution of each member does not exceed 15,000. Exempt transactions also include transactions which are exempt under international agreements to which the Philippines is a signatory. This includes gross receipts from lending activities by credit or multi-purpose cooperatives duly registered with CDA. Those lease of residential unit with a monthly rental not exceeding 12,800. Also, sale of real properties not primarily held for sale to customers or held for lease in the ordinary course of trade or business, or real property utilized for low-cost and socialized housing as defined by Republic Act No. 7279, otherwise known as the Urban Development and Housing Act of 1992, and other related laws. Residential lot valued at 1,919,500 and below, house and lot and other residential dwellings valued at 3,199,200 and below. So these rates are already revised under the train law. So exempt transactions also include sale, importation, or release of passenger or cargo vessels and aircraft, including engine, equipment, and spare parts thereof for domestic or international transport operations. It also includes transport of passengers by international carriers doing business in the Philippines. Also, sale or importation of lease of properties or cargo vessels and aircraft, including engine, equipment, and spare parts thereof for domestic or international transport operations. So includes sale or release of goods or properties for the performance of services other than transactions mentioned in the preceding paragraphs. The gross annual sales and or receipts do not exceed the amount of 1,500,000. So this amount is also revised under the train law. Creditable input tax. So input tax hereof on the following transactions shall be creditable against the output tax: purchase or importation of goods for sale, for conversion into or intended to form part of a finished product, for sale into packaging materials, or for use as supplies in the course of business, or for use as material supplied in the sale of service, or for use in trade or business for which deduction for depreciation or amortization is allowed under this code, and for purchase of services on which a value-added tax has actually been paid. So creditable input tax is the input tax on domestic purchase or importation of goods or properties by a VAT registered person shall be creditable on the purchaser upon consummation of sale, and on importation of goods or properties, and importer upon payment of the value-added tax prior to the release of the goods from the custody of the Bureau of Customs. So for capital goods which are depreciable assets for income tax purpose, so the aggregate acquisition cost exclusive of VAT exceeds 1 million in a calendar year, regardless of acquisition cost of each capital goods, shall be claimed as credit against output tax in the following manner. So if estimated useful life of a capital good is 5 years or more, so the input tax of capital goods divided by 60 months beginning on the month of acquisition would be the input tax to be claimed monthly. The manner of computing the VAT: if output tax exceeds input tax, so output tax less input tax is equal to VAT payable. However, if input tax exceeds output tax, so the computation is still the same. but there is a negative VAT payable and the unutilized input tax can be carried over to the succeeding months or quarter. The creditable input tax for capital goods which are depreciable assets for income tax purposes, the aggregate cost exceeds 1 million in a calendar year, regardless of acquisition cost of each capital goods, shall be claimed as credit against output tax in the following manner. So estimated useful life of a capital goods is less than 1 year. So input tax of capital goods divided by actual number of months comprising the estimated useful life of the capital goods beginning on the month of acquisition is the input tax to be claimed monthly. So for the purchase of services, lease, or use of properties, input tax shall be creditable to the purchaser, lessee, or licensee upon payment of the compensation, rental, royalty. So the allowable transitional input tax credits is equal to 2% of the value of such inventory or the actual value-added tax paid on such goods, materials, and supplies, whichever is higher, which shall be credited against the output tax. So for those processing of sardines, mackerel, and milk, so there is an allowable presumptive input tax of 4% of the gross value in money of their purchases of primary agricultural products. So for zero-rated sales, within 2 years after the close of the taxable quarter when the sales were made, so the taxpayer may apply for the issuance of a tax credit, certificate, or refund of a creditable input tax due or paid attributable to such sales. So where the taxpayer is engaged in zero-rated or effectively zero-rated sale and also in taxable or exempt sale of goods or properties or services, and the amount of creditable input tax due or paid cannot be directly and entirely attributed to any one of the transactions, it shall be allocated proportionately on the basis of the sales volume. And input taxes shall be allocated ratably between his zero and non-zero rated sales. So what are the invoicing requirements? First is the VAT invoice and second is the VAT official receipt. So what must be indicated in the invoice or receipt? So a statement that the seller is VAT registered followed by his TIN. So the total amount that the purchaser pays and the amount of tax shall be indicated. And if the sale is VAT exempt, it must be written or printed. If the sale is zero rated, it must also be indicated. And if the sale involves transactions for VAT zero rated or VAT exempt, the breakdown must be also indicated. Also the date of transaction, quantity, unit cost, and description. And in the case of sales in the amount of 1,000, so the name, business style, and TIN of the purchaser must be indicated. So what are the accounting requirements? First is the regular accounting records, also subsidiary sales journal, and also subsidiary purchase journal. So what are the consequences of issuing erroneous invoice or VAT receipt? So if he is not a VAT registered person but shows in the invoice that his TIN is followed by VAT, so he is liable for percentage tax. He is also liable for the output tax, 50% surcharge. However, the purchaser can claim that as an input tax credit. So what if he is a VAT registered person but he failed to indicate that it is a VAT exempt transaction? So he shall be liable for the taxes imposed in the output tax. So who shall file? Every person liable to pay the value-added tax. When to file? So VAT registered person shall pay the value-added tax on a monthly basis, and also there should be a quarterly return. So the basis is the gross sales or receipts and when to pay within 25 days for the quarterly and within 20 days for the monthly return. Well, for the EFPS, there are different types. So withholding of value-added tax. So the government or agencies, including GOCCs, shall withhold 5% based on the gross payment to the corporations or to the companies. And the value-added tax withheld under this section shall be remitted within 10 days following the end of the month the withholding was made. So cancellation of registration. The registration of a person who ceases to be liable to value-added tax shall be cancelled upon filing with the RDO. If there is a written application that the gross sales or receipts for the following 12 months other than those that are exempt will not exceed 1,500,000 pesos, and under train law it is now 1,300,000. And he has ceased to carry on his trade or business and does not expect to commence any trade or business within the next 12 months. So now we are done with the value-added tax. So let's now move on to the train law. So the history of train law. On December 19, 2017, President Rodrigo R. Duterte signed into law Package 1 of the Comprehensive Tax Reform Program, also known as the Tax Reform for Acceleration and Inclusion, or TRAIN, as Republic Act No. 10963. The law took effect on January 1, 2018. So the TRAIN aims to make the Philippine tax system simpler, fairer, and more efficient to promote investments, create jobs, and reduce poverty. Along with this objective, the CTPR also aims to raise revenues that will fund the President's Build project that will sustain high inclusive growth of the country and finance investments in the people through enhanced education, health, and social services. So the scope of the discussion are personal income tax, estate tax, donors tax, value-added tax, excise tax on automobiles, excise tax on petroleum products, excise tax on sweetened beverages, excise tax on cigarettes, excise tax on mineral products, documentary stamp tax, and other taxes. So for personal income tax, the TRAIN law restructures the personal income tax schedule with separate Schedule 4, compensation income earners, purely self-employed individuals and or professionals whose gross sales or receipts and other non-operating income do not exceed the value-added tax threshold of 3 million, and mixed income earners. So this is the old schedule and this is a new schedule under the TRAIN law. So under the TRAIN law, the tax brackets are reduced from 7 to 6 brackets, and it exempts the first 250,000 annual taxable income of the taxpayer, and it sets the highest amount of taxable income at more than 8 million and subjects it to the higher marginal rate of 35%. Also, other changes included in the TRAIN law is that it repeals the provision on basic, personal, and additional exemptions and premiums paid on health and or hospitalization insurance, which are deemed integrated in the 250,000 exempt threshold. It also retains the exemption from tax of de minimis benefits, as well as the non-taxability of mandatory contributions such as those made to the GSIS, SSS, PhilHealth, Pag-ibig Fund, and Union Dues. It also increases the amount of tax-exempt benefits ceiling for 13th month and other benefits from 82,000 to 90,000. For the self-employed and professionals, there is now an option for an 8% tax based on gross sales or receipts in excess of 250,000. So this option was not available in the previous schedule. And above 3 million, they are subjected to the personal income tax rate. For the mixed income earners, there is also an option of 8% flat rate based on the gross sales or receipts for gross sales or receipts not exceeding 3 million. And for those which exceed 3 million, they are subject to the regular personal income tax rates. So these 8% taxes based on gross sales or receipts are in lieu of income and percentage tax. So what are the tax reforms for the personal income taxes under the Train law? So in addition to what I have mentioned earlier, so there is also a 20% final tax on PCSO on lotto winnings exceeding 10,000. It removes the preferential tax rate of 15% for employees of regional or area headquarters, regional operating headquarters, offshore banking units, and petroleum service contractors and subcontractors. It also increases the fringe benefit rate from 32% to 55% and inserts a provision that the optional standard deduction by a general professional partnership may only be availed once, either by the GPP or the partners comprising such partnership. So for the estate tax, the Train law simplifies the estate tax schedule from a 6-bracket schedule with rates ranging from 5% to 20% to a single rate of 6% based on the value of net estate. So this is the old tax schedule and this is now the new tax rate. So as what we can see, there is now a flat rate of 6% based on the value of net estate. So the value of net estate is computed as a value of gross estate less allowable deductions. So what are the other changes on estate tax under the Train law? So it removes a deduction from gross estate pertaining to actual funeral expenses, or 5% of gross estate, whichever is lower, judicial expenses and medical expenses, but increase the amount of standard deductions from 1 million to 5 million. It also increases the amount of family home from up to 1 million to up to 10 million, and it also removes the condition that the family home must have been the resident's family home as certified by the barangay captain of the locality. It also removes the deductions for non-resident estates pertaining to expenses, losses, indebtedness, and taxes, but provide for a standard deduction amounting to 500,000 pesos. It also deletes the provisions that require executor, administrator, or any one of the heirs to include in the estate tax return that part of the non-resident alien's gross estate not situated in the Philippines to be able to claim deductions. It also increases the amount of gross value of estate provided in estate tax returns that requires to be supported with a statement duly certified by the CPA from 2 million to 5 million. So under the Train law, so the filing of notice of death repeals the provision of requiring the filing of notice of death of the decedent by his executor, administrator, or any of the legal heirs within 2 months after the decedent's death. So the deadline of filing extends the period with which the estate tax return should be filed from 6 months to 1 year from the decedent's death. And the payment on installment basis. So it provides for the payment by installment basis in case available cash is insufficient to pay the estate tax due. Payment shall be allowed within 2 years from the statutory date for its payment without civil penalty and interest. So for the withdrawal limit, it removes the 20,000 limit and it allows for any amount subject to a final withholding tax of 6%. So for the donors tax under the train law, it is now simplified because the donors tax schedule from an 8-bracket schedule with rates ranging from 2% to 15% was now changed to a single rate of 6%, based on the total gifts in excess of 250,000. So the 6% tax rate likewise applies if the donee is a stranger. So this is the old tax schedule, and this is now the new tax schedule. So as what you can see, there is now a uniform rate of 6% based on the total gifts in excess of 250,000. So other changes under the donors tax. So at arm's length and donative intent free sales, exchange or other transfer of property made in the ordinary course of business shall be considered as made for an adequate and full consideration in money or money's worth, and is therefore not subject to the donors tax. It also deletes the provision exempting from the donors tax dowries or gifts made by parents to each of their legitimate, recognized, natural, or adopted children on account of marriage. So for value-added tax, so there is broadening of the VAT base. So RA 10963 repeals provisions on tax exemption and zero rating under special laws to broaden the VAT base. So it also includes electric cooperatives in the definition of sale or exchange of services subject to VAT. And there is also withdrawal of zero-rated transactions. So under the train law, it removes foreign currency denominated sales from VAT zero rating and subject to the VAT indirect exporters and agents only upon the establishment and implementation of an enhanced VAT refund system. So the retention of VAT exemptions. Under the train law, it retains the VAT exemption status of the following: raw agricultural and marine products, health services, educational services, cooperatives, senior citizens, and persons with disabilities. So inclusion to tax-exempt transactions. So under the train law, it includes the following transactions to the list of VAT-exempt transactions under Section 109 of the Revenue Code. Sale of gold to the Bangko Sentral ng Pilipinas, sale of drugs and medicines prescribed for diabetes, high cholesterol, and hypertension beginning January 1, 2019. Also, association dues, membership fees, and other assessments and charges collected by homeowners associations and condominium corporations, and transfer of property in pursuance of a plan of merger or consolidation. So these are the adjustments to VAT-exempt threshold. So it increases the VAT-exempt threshold from 1,919,500 to 3 million, which is to be adjusted to inflation not later than January 31, 2021, and every 3 years thereafter. It also increases the present VAT exemption threshold on lease of residential unit with a monthly rental of 12,800 to 15,000 monthly. And it reduces the VAT exemption threshold from 3,199,200 to 2 million on sale of house and lot and other residential dwellings beginning January 1, 2021. So for the excise tax on automobiles, so under the train law, it restructures the tax schedule on the excise tax of automobiles by imposing ad valorem tax rates that are directly applied to the net manufacturer's price or importer's selling price instead of imposing marginal tax rates as follows. So this is the old tax schedule, and this is now the new tax schedule. So these are important notes about excise tax on automobiles. So hybrid vehicles or vehicles powered by electric energy in combination with gasoline, diesel, or any other motive power shall be subject to 50% of the applicable excise tax rates on automobiles. Purely electric vehicles and pickup trucks shall be exempt from excise tax on automobiles. Pickups shall be considered as trucks, and the term jeep was deleted from the definition of jeep, jeepney substitutes, which shall now read as jeepney or jeepney substitutes. So, excise tax on petroleum products. Under RA 10963, it increases the tax rate on petroleum products in 3 tranches, beginning January 1, 2018 to January 1, 2020 as follows. So this is the old rate, and these are the new tax rates from 2018 to 2020. So these are the important notes. For the leaded gasoline, so it is phased out or deleted under RA 10963. So for the kerosene, when kerosene is used as aviation fuel, it is subject to the same tax on aviation. For the LPG, under 10963, when LPG is used as raw material in the production of petrochemical products, the tax is 0 per kilogram. And for petroleum coke, when used as feedstock to any power generating facility, the tax is 0 per metric ton. So the excise tax on sweetened beverages. So it is 6 pesos tax on sweetened beverages using purely caloric sweeteners and purely non-caloric sweeteners, or a mix of caloric and non-caloric sweeteners. And it is 12 pesos per liter of volume capacity tax on sweetened beverages using purely high fructose corn syrup or in combination with any caloric or non-caloric sweeteners. And sweetened beverages using purely coconut sap sugar and purely stevia glycosides are exempt from this tax. So these are the beverages covered in this excise tax: sweetened juice drinks, energy and sports drinks, sweetened tea, cereal and grain beverages, flavored water, other powdered drinks not classified as milk, juice, tea, or coffee, all carbonated beverages, and other non-alcoholic beverages that are with added sugar. So the beverages excluded from this excise tax are milk products, including plain milk, infant formula milk, powdered milk, and others, 100% natural vegetable juices, meal replacement and medically indicated beverages, 100% natural fruit juices, ground coffee, instant soluble coffee, and prepackaged powdered coffee products. And there are also other excise taxes. First is on cigarettes. Under the train law, it increases the excise tax rates on cigarettes packed by hand and packed by machine as follows. So this is the old rate, and this is now the new rate. So as what we can see, the taxes are relatively higher on the new tax rates. So there is now an added excise tax on these cigarettes. So other excise tax on mineral products. So under the train law, it also increases the excise tax rate on domestic or imported coal and coke in 3 tranches, beginning January 1, 2018 to January 1, 2020 as follows. So this is the old rate of coal and coke, and so as what we can see, it has now a new rate of 50 pesos in 2018, 100 pesos in 2019, and 150 in 2020. And for the mineral products, which include metallic minerals, copper, gold, and chromite, and also indigenous petroleum, these are the old rates, and this is now the new rate. So as we can see, it also has increased relatively compared to the old rate. For the documentary stamp tax, the train law also increased the documentary stamp tax rates by 100%, except DST on debt instruments, which only increases by 50%, and a documentary stamp tax on policies of insurance upon property, fidelity bonds, and other insurance, indemnity bonds, and deeds of sale, conveyance, and donation of real property, which remain unchanged. So for the foreign currency deposit unit, so it also increases final tax imposed on interest income derived by an individual and a domestic corporation from a depository bank under the expanded foreign currency deposit system from 7.5 to 15%. It also retains 7.5% final tax on interest income of a resident foreign corporation. Also, other taxes, capital gains on non-traded stocks. It increases the 5% to 10% tax rates to a 15% single tax rate on net capital gains realized by an individual and a domestic corporation from the sale, barter, exchange, or other disposition of shares of stock in a domestic corporation that are not traded in the local stock exchange. However, it retains a 5 to 10% capital gains tax of a resident foreign corporation and non-resident foreign corporation. So, other taxes also include stock transactions tax. So, it increases the stock transaction tax from 0.5% to 0.6% of the gross selling price or gross value in money of the shares of stock sold, bartered, exchanged, or otherwise disposed through the local stock exchange. And also, there are other taxes on cosmetic procedures. So for the new excise tax equivalent to 5% of gross receipts net of excise tax and VAT. And it derived from performance of services on invasive cosmetic procedures, surgeries, and body enhancements directed solely towards improving, altering, or enhancing the patient's appearance. And that concludes my discussion on taxation. Thank you so much for watching.